Welcome back to the Wall Street Podcast. Today we're diving straight into a pretty crucial piece of research. It's the Goldman Sachs report, China Consumer Staples, Snacks, Spirits, F&B Hunan Tour.
That's right, released September 24th, 2025.
And it's based on, well, actual on-the-ground checks in Hunan, looking at consumer sentiment right before the big festival season.
And the headline finding is pretty blunt, isn't it? Demand continued to be sluggish through July and August. Sentiment is weak.
Yeah, weak is putting it mildly, perhaps.
Well, what seems clear is we're looking beyond just a temporary dip. There's this theme emerging, a kind of structural collapse of brand premium.
Okay, so starting with spirits.
Exactly. Channel checks confirm inventory prudence is absolutely key right now. And prepayments, those essential cash flow guarantees, they're way behind last year for the major players.
And that inventory pressure, it's hitting pricing hard, I assume.
It is. Look at Willianji. They're destocking aggressively. Average bottle price fell to RMB 880.
Wow, RMB 880. That's down sharply from what, RMB 940 pre-Chinese New Year? Is that 880 price even sustainable? Or are they just, sacrificing future brand equity to clear stock now?
It's probably a necessary sacrifice in their view. If inventory just sits there, brands can't push new products, and critically, they can't lock in those H2 prepayments. It stops being just about sales figures.
Right.
Inventory risk becomes corporate cash flow risk, fundamentally.
So if premium spirits are feeling it, does that problem spill over into more everyday items?
Yeah.
Beverages, dairy?
Oh, absolutely. Let's look at F&B. Nongfu Spring, for example, they're facing a tough Q4.
What's that?
Mostly because of a really high base from the previous year, makes comparisons difficult.
Got it. And dairy.
Sell-through weakened quite sharply mid-August. We saw Yili and Menu posting declines, high single digits, even double digits in August.
Ouch. Any bright spots there?
Well, it's segmented. Consumers seem to be protecting spend on premium UHT milk and yogurt segments. Those are resilient, showing softer demand compared to basic milk, which is really falling off.
Okay, and snacks. You mentioned the consumer value hunt earlier.
Yes, and snacks are where you see it most aggressively. Brands are shifting strategy, focusing on customized CQs, working directly with discounters. Think House Shanglai.
And that collaboration, what does it mean for pricing?
It means significant price advantages. We're talking 16% to over 40% cheaper compared to traditional convenience stores.
40%.
Yeah. This isn't just trading down a bit. It feels more like a structural shift. Retailers are gaining power, really changing that traditional brand dominance.
Okay, let's maybe unpack this with our three modules. Question 1. Beyond just weak sentiment, what's the single biggest risk for premium spirits guys like, say, Jugi Liquor?
It really boils down to channel inventory management. They need to stabilize wholesale prices. Jugi is destocking, yes, but the real risk for investors is whether H2 prepayments recover.
And that's why Goldman has them as a sell.
Exactly. A sell rating with an RMB 20.9 target price. It just highlights how serious that cash flow challenge is perceived to be.
Okay, shifting gears a bit. Despite this broad weakness, are any channels actually showing some resilience, maybe even growth?
Surprisingly, yes. The traditional CVS, convenience stores and the mom and pop shops, they're proving quite strong.
Interesting. How so?
Yanker gives a good example. They're actually pulling back from high-cost online sales channels like Douyin and instead using these neighborhood CVS channels for market penetration, especially for their big products like konjac. It's proving pretty robust.
All right. So third question then. How are consumers actually changing their buying habits at the product level in response to all this?
They're laser-focused on immediate value. That huge price gap you see at discounters, that's a direct reaction to squeezed household budgets.
So less brand loyalty.
Much less. It's about strict optimization now, though they are still defending spending on certain subcategories they see as higher quality or resilient.
Like the premium yogurt you mentioned.
Exactly. Things that offer a small perceived step up in value without a massive cost increase.
And the relevance for you, our listener, is pretty clear then. You can see it in your own shopping.
Definitely.
The fact that retailers can offer staple items, everyday things, at discounts of up to 40%, it just confirms households are driving this fundamental shift, moving away from brands towards immediate value.
Precisely. And the core message from this Goldman report really is that any recovery in consumer staples overall, it's secondary to successfully managing this channel inventory risk first.
So the big question for investors.
Yes, the fundamental question is whether corporate restructuring, like Jugu Liquor's partnership with Pangdamglai, which has a respected retail model, whether that can actually generate enough momentum to offset weak underlying demand.
A structural fix versus weak fundamentals. That's the tension to watch.
That's the key question going forward.